Okay, so Billy, you guys, credit scores, all of that stuff, everybody, it's like literally like a mystical land of unknown information.
It is a mystical land.
But like I will say that it's also a massive stress point, right? What's my credit score? How do I check it? I don't want to talk to lenders because they're going to pull my credit. Then I'm going to get calls from all these lenders. It's like, where and how does your information get sold?
The second they pull your credit report, whatever information was inputted to pull your credit gets pulled and sold immediately. So there's steps around it. You can put yourself on the do not call list. The
Which
registry.
is like, but they don't, whatever. They don't listen to that.
No one listens to that. No one listens
And then
to that.
how are you going to report it?
It's, you can go online and do it easily, but it's still a nightmare because then also you're not getting calls from other outside companies you actually need from. So I don't like the do not call list. What I like is lenders being responsible about pulling your credit.
Yeah.
What I mean by that is, one, you have to give authorization. We like to get it verbally over the phone. We also like to, on our application itself, you have to click a button prior to submitting it, letting us know that you're interested in a credit inquiry. But there's steps that we take on our end to make sure that you don't get littered with phone calls by removing your phone number. We remove the email address. We even remove the work number because, believe it or not, these creditors will contact your place of work if that's included on your application.
Well, it is so brutal.
Oh.
It's so brutal. It's like, and again, like look at this Mr. Irony over here, right? I work in the online lead space. So when I do get a lead, we will explode your phone.
Yeah.
Like that is the way that I built my business. That is the way I'm going to continue to build my business. But goddamn, do I hate it on the other side.
I mean, everyone hates getting random phone calls from people.
But we've built our business out of that. But
So I built a mansion off of that. Let's go.
yeah, but at the same time, though, like because we're in this, we also know how to protect people that don't want that, right?
Yeah. So in the steps that we took in place, we actually just started doing this about 8 months ago. Like when it got really, really bad.
Yeah, it's like it's gotten like a lot worse.
It's gotten
recently,
a lot
right?
worse.
Is this people are thirstier or like what's going on?
Here's the issue is that when we pull on the mortgage side, that information is stored for 7 years. So if someone recently applied for a car payment, for a new car, I'm sorry, or they applied for a credit card, and if they kept their contact information in that application, when we pull it and it shows an inquiry, their old info gets pulled through with it too.
Okay.
So we get to take our steps up front to protect the client. But if they recently had an inquiry and if they inputted the information,
So it's like
their info is still
It's like
being
mass
sold
data
again.
absorption because they know what you guys are doing. So like then they're like, all right, well, what's the next? Because people will find a way.
And it's
Life
coded.
finds a way.
And it's coded too. So whenever a mortgage company pulls your credit
God.
report, there's a code on it that it came for a mortgage inquiry specifically.
Yeah.
So as soon as the mortgage inquiry is submitted, your phone is going to start ringing right away.
You know how like in Jurassic Park they say life finds a way.
Yes.
Yeah, creditors will find a way.
They find a way. They find a way.
They're like basically the new age dinosaurs.
And here's the thing too about these
Right?
companies that are doing it is
Get it?
I like that dinosaur play on that. He did do a good job on that. I like it.
The new age Jurassic Park. I'm so good about it.
Jurassic Park 9.
Mm-hmm.
There's 10 of those damn
And it's
things
just
in there.
creditors calling you. What's your
Just
fucking
nonstop.
credit score? They're like, I don't understand what is happening.
Just-
Like,
I've seen clients after they submitted it run away like they're getting chased by a dinosaur, and the only way to do that is to then go on the do not call list, the do not call registry. to
dude,
get
that
yourself
should be
removed.
that should be a move. That should be our advertising move. Why they should use Stonehaven?
because we protect your information.
Yeah, and then the T-Rex that's chasing them are other creditors.
Should make that a commercial.
Dude, that's
I'll
dude,
be
we
the
just we missed it.
dinosaur.
We should have gone Super Bowl with
I will
it.
be like we're in those blow up T-Rexes.
No, we should. Like, actually, I was gonna say, okay, now that I'm thinking about you in a dinosaur costume, yes, absolutely. Like low budget, we're like in one of those red flyers. Like you're running and pulling the red flyer, and I'm like with my client in the
Would
back.
it
and
surprise
probably-
any of you if I told you that?
What are we talking
I
about?
once went for Halloween as a blow up dinosaur once before. You got on Jurassic Park,
I know.
man.
I'm so sorry. I got real excited. Okay, back to good
Credit.
information. When it comes to like while you're under contract and everyone's like, don't buy a car when you're under contract. Like, don't do anything. Don't pull any. Don't even like apply for a new credit card.
Don't. And you know what a lot of people will do too? It's not so much the credit card.
Yeah.
Once people get a couple weeks into financing and they personally feel that they're already clear to close or they're good to go, I supplied all the documents. That's not the way it works out. No matter what, inevitably, it's the underwriter's job to make sure that they are finding something to ensure the saleability of the loan. That if it's the cleanest file in the world, we're going to come back and request an updated document. They just want to do their job.
Yeah.
They just want to do their job.
Yeah.
So if you go out and you think you're good to close, what do you think you're going to do right away? Start furnishing your house?
Uh-huh. buying a couch.
So instead of going for credit cards, they go to Ashley Furniture. They go to Van or wherever, and they set up essentially a credit card with them to purchase the furniture. Information's being sold again.
Oh man.
Another credit inquiry. We get notified the second that you apply with that furniture store that you applied with them for financing. That could derail an entire transaction right there.
Oh my God, dude.
Didn't you and I had a borrower that purchased a house cash once while we were doing financing 4 years ago, I think.
I don't remember.
Was it named Venu, I think? Never mind. Actually, I kind of want to touch on that.
You want to touch on it?
I do.
Okay.
So people, when you're getting financing, do not apply for anything.
Right.
Don't even apply for furniture until you are closed on the property.
Yeah, like you've moved in, you've got
going to create
keys.
inquiries. That goes without being said. Then don't purchase a car. Don't purchase a boat, which I've had happen. And I had a client once purchase a house with cash while closing with us financing. And in his head, he thought that he was good to go because he doesn't have any debt obligation with the property. Person no longer qualified for the home we were financing because of the taxes and insurance on the home that he purchased with cash. So it goes without saying.
But wait, what would be the strategy there if you're buying it cash and getting financing for it? So just to kind of like what is the point?
Wanted to acquire another property with cash and thought that it wouldn't affect his financing. So it just goes to show, even if you're
Oh,
purchasing,
he bought another house with cash.
another house with cash.
Oh, I thought he bought the same house with cash.
He
I was
bought
like, that
another
doesn't make
house
any
with
sense.
cash, which then added to his debt, no longer qualified for the loan. So it goes without saying, don't apply for new credit cards. Don't go purchasing furniture. Definitely don't buy a new car. Don't go buying that boat, and do not buy another house when you're getting financing.
Don't go chasing waterfalls.
Don't go chasing waterfalls.
Okay.
Just stick
Makes
to the
sense.
rivers and streams that you're used to.
God, man, we wish we
I know that we're going to have it one way or nothing at all. Are we moving too fast?
A little bit.
Okay.
How do people know what they can afford?
Typically, people will come to us with a budget in mind of what they feel their comfortable payment is. On the flip side of that coin, people will come to us and ask us, what do I qualify for, and want to get maxed out. I do not suggest clients maxing out their financing because we qualify the borrowers for their potential financing gross income, which you're actually going to be paying those debts with your net income. So I like when clients have budgets put together. The way that we do it is we will max out the borrower's pre-approval so they know how high they can go on paper.
Yeah.
What we then do is we have a phone call with the client to work backwards and say, what payment are you comfortable with? And if they tell us, I want to be at $3,500 a month, we can do the math backwards. We just work backwards into the payment that they're comfortable with and then let them know what price points to be looking at, along with tentative tax payments, the annual taxes, and homeowner association dues if it's a condo or a townhouse.
Okay. Tell me about PMI. When do people essentially get it? And then how can you get it off of your monthly payment?
Private mortgage insurance is applied to a transaction when a borrower is putting down less than 20%.
Okay.
So the way that it works is when the person's putting down 20%, the banks are more comfortable, statistically speaking, with the fact that that client is going to continue to make their payments on time. When they put down less, they're not as confident. So the mortgage insurance gets put in place to protect the lenders themselves. The PMI is on a mortgage until you get to 80% loan to value, so 20% equity in the home. You can with that though, here's the caveat with that most clients are not aware of. At 80% loan to value, they have to call the servicer to get those payments canceled. Once you get to 78% loan to value, it automatically goes away.
Got it. Now, strategically, right? I've heard where if you're at like 19%, maybe 18.5, like you're close, you can call and sometimes get that off.
You can.
Okay. So like basically just be like very cognizant of where you're at with how much you own. But like also, let's say that you're like, this is what I did with my house in Emmondale, right? I put 5% down to buy it, right? There's a massive surge in value in the area within the like first year, right? It just was like one of those crazy. I got it reassessed, got a new loan, and it got out.
Yep.
Right. So it's like also if you're assuming that if you did some renovations to the house, if you got the home value up, if the like right now, right, people are somebody that bought in January will probably enjoy about a 5 to 7, maybe 10% appreciation in their home value in the next 6 months.
Oh yeah.
So it's like if you put 10% down, probably by the end of this year, you can get your PMI off just from the valuation increase alone.
Even in that scenario, if you refinance, the PMI is going to go down because of the appreciation. Like you're going to win no matter what.
Yeah.
You're going to win in this market. You are definitely going to win. So if you don't have the funds to put down right now, we will have clients that, let's say, this is a great scenario to talk about with PMI. Let's say you have a current home to sell and you don't have the cash to put down and you want to use the equity from the house. Purchase the new home with 5% down.
Yeah.
Primary property, 5% down, get into the property. And then if you have the wherewithal or the capabilities to do so, sell your home after the fact. The money that you get from the sale of your home, you can do what's called a recast on the mortgage, where they're going to take a lump sum principal reduction and they're going to adjust your payments based on the time left on the loan. So you don't necessarily have to refinance that. You can do a recast and you put principal payment down on that. The MI goes away. Your monthly payment's going to adjust. So that's an avenue for clients to look
That's
at.
a
For
strategy
sure.
right there. That's a move.
Yeah.
Yeah. What are some good questions that a borrower should be asking the lender?
Besides, what is the interest rate?
Yeah.
What is your fee? And does this interest rate carry any discount points? So a discount point is typically 1% of the loan amount. So if you got a $600,000 loan amount, you can be paying $6,000 up front, not even know about it, because a lot of lenders will just send out their terms without discussing it with the client by charging points up front. The points are going to adjust that interest rate lower to decrease the monthly payments.
Which is like what we were just talking about a little earlier, is like if somebody is a point less than your other, let's say that like the average is 6 from your other, lenders that you're talking to, then all of a sudden this guy's at 5. Like, wow, this guy's great. Oh, wait a second, he's charging a point.
Ask immediately, does that interest rate carry any discount points?
Got it.
Immediately, because a lot of lenders right now are just stating my interest rate is X and not disclosing that there's a discount point on it.
Yeah, because at the end of the day, people will react to the lowest number.
Correct.
And they don't necessarily look at the details.
So you ask what the lender fee is. You ask, does the interest rate carry any discount points? And also ask what the appraisal fee is, because those would be the 3 main comparables between lenders. Then you should also ask, what's your typical turn time?
Yeah, right.
Because we're operating on a 7-day turn time. You can end up having an investor that, if you get a contract for 45 days, that might tell you that could be an issue.
What is turn time? That's from
turn time is from accepted offer to once we get the final approval.
It's like the clear to close.
The clear to close.
You can close the next day or the same day.
Correct.
Okay. So let's say, like, as a borrower, right? This is like the time we're past inspection. It's time to lock in a lender, right? It's like high stress. Let's go. What would be the best tactic to make sure you get the best terms, the lowest fees, and the best lender?
Well, no matter what, we're going to do everything in our power to make sure that we earn your transaction.
Right.
And we do that by suggesting to clients to go out, and if you want to shop us, shop us.
Right.
We're not going to lose sleep over it.
Yeah.
You should be doing your due diligence as a borrower.
Would you say that they need to shop at least 3 people, 3 brokers?
I wouldn't go 3. I think if you have, 3 in total.
Yeah.
I would say 3 on top of the first one you talk to, but 3 in total, because a lot of banks are going to be in line with each other in terms of costs and fees. So the turn time is really the big kicker there.
Yeah.
But do your due diligence, make sure you're getting the best terms possible, and then, no matter what, a bank should be willing to meet it or beat whatever you're getting over if they want to earn your business.
Mm-hmm. Do you know why a credit pull is a soft pull and not a hard pull?
Well, there's 2 different credit inquiries. There's a soft and a hard.
Right. So, like, why is it when it comes to a pre-approval? And I'll tell you why we're laughing. When it comes to a pre-approval and you want to get, a lot of people are like, I don't want my credit to get hit. Why is it when you guys pull, right, it's a soft pull and it doesn't hit the actual credit score?
That would be an IT question for how they code that.
Why? So it's more of a
it's literally coding things. So if you look at,
it's a better answer. It's fucking bad. Kyle was like, I don't. Kyle literally was like, I don't know.
No,
it's like if it's hard, you're soft. If you're soft, you're hard. You know what I mean?
Oh my god.
Stay hard, you know what I mean? Don't go soft. Don't go soft. You know what I mean? You know what I mean? The Jurassic Park hard.
No. Stop. Jurassic Park.
He said
hard?
This.
He said Jurassic Park hard?
No, I just made that. I'm bringing it full circle.
All right. This is from what I've been informed. So it really is a coding thing. So a soft credit inquiry is going to tell us all of the monthly obligations.
Okay.
It's going to tell us the balances on the accounts compared to what the limit is, and it's going to give us a score. But it doesn't allow us to actually go through automated underwriting, which is how we issue pre-approval letters.
So, okay, got it. So it's like it's your beginners.
Let me take that back.
Okay.
Let me take that back. So the soft inquiry is going to show your scores and all your monthly obligations. So that way the lender can work up what's called the debt to income ratio.
Yeah.
Gross income versus what's going out per month.
Which then you can give them like
so then that way they can see what that debt is and make sure they qualify.
Okay.
And then where the hard inquiry, we actually go back further. So a hard inquiry is going to show more items, like medical collections or, any other obligations that are in the past that wouldn't pull on a soft, because a soft inquiry is going to look like your personal inquiry from Capital One.
Got it.
Your Credit Karma.
That makes so much sense.
So the soft inquiry is not as in depth as. Don't talk to me about some of the stuff that he knows. Then he knows some stuff where I'm like, is that really how it works?
Yeah.
I didn't know that.
It's like a little kid.
Sometimes I'm like,
Yeah.
hard dinosaur.
What's the difference between a soft dinosaur and a hard dinosaur?
T-Rex just going, ah.
Another commercial, man. We were really missing out.
No, let's do this dinosaur thing.
Yeah,
I'm in.
I think we absolutely should do this.
I'm buying a dinosaur outfit and just walking in it.
Okay. Down.
Yeah.
Okay.
Watch this happen.
We're
Did
finally
I-
like.
Dude, I literally went as a T-Rex once
Of
for
Jurassic Park. You've seen Jurassic Park.
Is that our theme music or do we have different?
Well, you can't change it. It's classic. You do that, everyone understands the reference.
Lizards in Jurassic Park? Sure.
You've never seen a
Lizards in-
dinosaur? A lizard is literally a mini dinosaur.
But there's lizards in Jurassic Park.
It's mini lizard.
Yeah.
Mini
The ones
dinosaurs.
that climb up the trees.
Yeah, those are dinosaurs.
It's giraffes.
Did you know birds are dinosaurs?
Birds are dinosaurs.
We also talked about how birds are spies.
Yeah, there is. Did you see that pigeon that was a spy for the Chinese government?
I did read about that.
Yeah, he got jailed.
God, he was in jail for like 8 months. They're like, the prisoner was released today. I was like, the bird literally doesn't know what the fuck is going
Has
on.
no clue what's going on.
Bird was like, what just fucking happened?
His life probably got like expanded by not getting eaten by another a bird.
What do you
prey.
know?
What do you know? Tweet, tweet. Did the cat just meow? Did the bird?
Yeah. Yeah.
I'm so lost and confused.
I don't know.
Lost Worlds, Jurassic Park.
Lost World.
See how we just brought that back? That was
Okay.
in one of the movies.
You just said a random word. That's not bringing it back.
Lost Word.
This is how it goes every Monday with Greg and
I like this.
I. Yeah. We have fun.
You guys do this every Monday?
Yeah, I'm gonna crash it. Are you gonna do it? Do the goal.
No. This is a serious.
Do the goal.
Did I answer the credit part? Okay.
You way better than Kyle.
Way better. Literally, he said hard is hard and soft.
No, he said I don't know, and then he said hard and soft things.
No, the main part is the soft credit pool is
He
going to
just
act
like started
like
like freak out. He like started sweating, and that was it.
like Usher.
Yeah.
Did you see Usher sweating at the Super Bowl?
I see.
That rollerblader like literally fell off stage.
No, I just saw him almost trip, and I was
No,
kind of
rollerblader,
hoping that Usher
like-
fell in the roller skates, just because I'm like roller skates.
Yeah,
It's Usher, baby.
rollerblader, like literally.
I mean,
He also made me feel like less of a man when he took his shirt off and everything, and like all the women at Super Bowl are like, and I'm like, I'm gonna put on a coat. I'm not in shape.
dad
Greg.
bods are in
I hope so.
forever. So like we're talking about, the typical conversation is 30 versus 15, right? When is it better to, or like, the ARM, the adjustable rate mortgage, like how should somebody look at the term of the loan when they're making a decision on which to get?
So typically, if we're going to take a client from a 30-year to a 15-year, they have to qualify first. And a lot of borrowers it just seems the trend right now, borrowers are doing everything they can to get into the homes in this market. That 30-year makes more sense just for qualification and budget purposes. But if the borrower has the ability in their debt with their income to do a 15-year, they're going to save a ton of money on interest on the 15-year. Because again, it's amortized only 15 years versus the 30 years. So you're going to have a lot more interest that you're paying on a 30-year versus the 15-year because you're in it for half the amount of time.
Yeah.
And the interest rate is typically a half a point lower than what a 30-year fix is.
Okay.
So that's a lot of rate sensitive people will always come out and ask, what is your 15-year term versus your 30-year term? ARMs right now, I am a fan of ARMs, but
Which is
not right at
adjustable
this
rate mortgage.
Adjustable rate mortgage, correct. It typically the ARM rates were lower than the 30-year fix options, but that's not the case right now because the yield curve, just the way that I don't know.
IT.
Coding.
It's an IT. It's coding question. Okay.
No. The yield curve on the ARMs is not playing with us in the market. So right now, an ARM rate is literally the same as a 30-year fix. So it makes no sense to go into an ARM.
Yeah.
Why go into a 7-year ARM, which means it's fixed for 7 years and can adjust up or down after that?
Yeah.
When a 30-year fixed mortgage is the same.
Because typically, like before, it's like the arm would be way lower, right? But it's like it could adjust in 7 years. But I'm like, listen, I'm only going to be here for 5 years, so just take the lower rate. You're going to sell in 5 years anyways. It'll be fine.
Now, where ARMs are wanted right now is in the jumbo market. So anything over that 726 threshold for loan amount.
Okay.
The jumbo market doesn't follow the conventional mortgage market. So jumbo ARMs are better than the 30-year fixed ARMs. So if you were to do a jumbo ARM, you're probably going to save 1/4 of a point by doing a 7-year ARM versus a 30-year fixed jumbo. And especially once you get into loan amounts over that 726K mark, 1/8 of a point saves you so much money.
It does. It's just crazy how much, like, how important it is to shop, how important it is to get your rate down, and how important it is to do all of this stuff up front, because literally, like, the smallest adjustment interest rate saves you hundreds of dollars typically on a monthly basis.
And that's one of the advantages of working with Stonehaven is that we can put you into that ARM as a jumbo client, make 6 months payment on it, however long you're in until the rates come down, and we can refinance you.
Yeah.
And at that point, maybe you look at a 30-year.
Yeah.
Maybe you look at a 7-year again if it's more aggressive, and just keep on going.
Options.
Can
you give me money?
How much do you need?
What's that?
How much do you need?
The cost of the house?
Give me about 10 years.
Nice.
Yeah.
So all right, we have borrowers, right, that have in the best position possible. They have the ability to get a gift, right? So like there is a first-time home buyer. Parents are going to be helping them out. They're going to give them 50 G's as a gift for a down payment.
Correct.
You know, let's just start by, like, that is a fantastic place to be in your life. Be very thankful for your folks if they're doing that.
Very thankful.
But how does that work in regards to if it's not your money? Because you can't just do it on day of, right? They
can't do it on day of.
They just can't just bring you a briefcase of cash to closing. So how do you do that properly?
So we are informed up front at time of application how much the borrowers actually have to put down on the property. And usually I would say 9 times out of 10, the clients are upfront with us that they're going to be getting a gift.
Yeah.
If they don't tell us, inevitably, once they get under contract, we ask that question, where will the funds for down payment be coming from, just to ensure there's no surprises.
Yeah.
In terms of the gift, it used to be that when we were documenting gifts that we would have to get the bank statements from the donor, show the money going into the account, get a canceled check, show the wire was received, et cetera, et cetera. And if those bank statements from the gift donor had large deposits in it, then we have to go back and source those large deposits. The easiest way to do it is we get a gift letter that is detailed with the account that the funds are coming from.
Yeah.
We have those funds wired to the closing table so that we don't have to get invasive with the donor.
Got it. Okay. But true or false? The money should be seasoned for 60 days in your personal account.
True.
Right. So if you're closing, let's call it
if the funds are getting given to the borrower.
Okay.
Like what do you mean by?
So like let's say like Mike's example, like they're getting $50,000 from their folks, right? Doesn't it have to be seasoned? Meaning it needs to sit in the current borrower, the actual person's getting the loans bank account, for 60 days plus.
So money needs to sit in any account for 60 days for it to be considered seasoned.
Okay.
If they are getting a gift from their parents, we will instruct during the pre-approval process to not receive any funds at that point. Get it once you get under contract, because then we can go the route of having the funds wired to the title company the day of closing and not have to be invasive and get documents.
Oh,
so we don't typically want to see the gift given to the client and then the client wires the funds. We can do it to where the client wires their portion of the down payment to closing, and then the gift donor wires their portion.
As long as, like, okay, well, this is going to come from this institution, meaning my folks' account, whatever.
Correct.
Got it. Okay,
Correct.
cool.
We
That's good to know.
document all that. Yep.
Okay.